Good morning. I want to invite those who are waiting on us to get to declare a small break so that we could be able to, and those who are ushering us also, maybe to take seats at next table so that we are in very good. I want to welcome our analysts, our team from the Fourth Estate, our shareholders who have come this morning for our investor briefing for the first quarter of 2019. We are glad to have you. Your presence here demonstrates interest in following the performance of the investment that you have in Equity Bank along this institution. I'll go straight to the presentation, and we'll start a couple of minutes on the microeconomic and operating environment. And we have seen that the microeconomic operating environment is improving for the better. When we look at the whole region, we see the interest rates. As we can see, the highest central bank rate is 10% in Uganda. So we can see that the rates are sort of in harmony, and we can really describe the interest rates as low, given that we know we are operating in an emerging economy or region. When you look at the GDP growth rate, that's really the most telling one. We see the whole region averaging above 6.5% growth rate. And that compared to the African growth rate of about 3%. And the region is growing faster, twice as fast as the African continent, and maybe three times faster than the global economy. So we are in I would say, our operating region, solid microeconomic environment, strong growth rates. And those growth rates, as we can see, are anchored on supportive monetary policies, exchange rates that are stable, inflation rate in the whole region seems to be low, and a strong economic growth outlook. And this is the same confidence that the bank or the group has adopted in its projections and in preparing for the year. The ease of doing business and attractiveness in the region, you look at Kenya and look at the other countries, the whole region is starting to attract global capital and global investments because of that attractiveness. So we can generally say there is a strong wind that is brewing, and our responsibility as management is then to lift the sail so that we can benefit from the impact of that wind. We're also seeing significant focus on the vices that needs to be dealt with, whether it's economic crimes. We're also seeing strategic initiatives like in Kenya, and we are seeing stability of the region being a focused area. And one of concluding about interest capping. So in an economic indicators are positive, robust growth has started months of the bank. That has caused us to prepare for maybe rapid growth. And the institutional structure and governance structure is being strengthened. And we'll see more and more of strengthening the structures and the human capital required to manage now a rapid growing organization. So that, as we can see, continue to be. The areas of focus then are now even more focused, are sharpened, laser sharp focus on these areas to drive and to tap into the anticipated growth rate. So turning to the first one, non-funded income, we see growth have started showing of non-funded income. And when you look at the loan interest income growth rate, despite our yield coming down from 16%, Alex, the next slide, we now see that we have a sustained trend of interest income. I just want to remind maybe you about our yields before interest capping 2016 were at 16%. The gross interest rate now is 13%. It's not even 14%, it's 13%. But we have seen that the total interest income, despite losing 42% of what it used to be, has now, again, suggesting and confirming that the organization has been able to adapt itself and take an interest capping now as a new norm. We can operate efficiently in a low interest regime comfortably. For us, that really is maybe the biggest achievement of the last 2 years. How do you adjust the engines to be efficient, to be able to generate more income with very low margins, for 60% of what it used to be. And we also see Treasury has upped itself, and so we see consistent growth, 7%. And the non-funded income, again, we've now seen momentum for growth and contribution to total income. We can see how it is split, and the non-funded income has bounced back to what it ought to be, around 42. And when we look at what is contributing that non-funded income, we see it's not one source of fees or commission, or it's transaction fee. We have seen transaction fee as reflected by the mobile banking. We said this last year, that the promotion will be over and we'll start seeing significant growth in transaction fee, but more importantly, in customer-driven streams of income, whether it's Forex, whether it's bond trading. Let me go out the Forex trading income. This is tied out to our success in diaspora banking. Essentially, the remittances come in dollars, so we have significant pool, sizable pool of dollars to be able to drive our foreign exchange trading in the market, and that growth. So you might see that we have created a balance between diaspora remittances income and Forex income, and we have opted to focus on Forex income so that we encourage diaspora remittances to grow significantly, and the revenue comes from Forex trading as opposed to commission. That makes us very, very competitive, and we can build significant volume. And that is a line that of us. Merchant banking, and we all know that now if it is something like Visa, as we can see, every quarter we're seeing growth in market share. And now like Visa acquiring, we're controlling 42% of the market share. So again, it's a spread over a couple of lines of income, diversified sources of income, again guaranteeing sustained growth. And that, when we put it in perspective, we see that now other income has bounced back to contributing 41%. Our target is 42% of the income to come from, and within 1 year, moving or 1 quarter, moving from 38% back to 41. That again shows the focus on that area. The good thing with non-funded income is the quality of income. It's realized. There is no crowback. there are no provisions against it. It's realized income, and essentially, it's a high-quality line of income. Looking at Treasury, again, we see the efficiency in Treasury and the maybe latent profitability that is inbuilt within the Treasury functions, particularly as regard government stock. As we can see, we have stemmed off the growth of Treasury boards. Why? Because we have been able to rebuild our rating engine strategically to be able to grow loans under low interest regime. But more importantly, the strategy has been validated. That as government security, yields on government securities decline, our mark-to-market gains grow significantly. As we can see, the gains have grown by 110%. So the reinvestment risk that one would have seen, we have avoided it by, instead of reinvesting in Treasury, we are now, on maturity of Treasury boards, we are now investing in lending. So the investment risk has been managed, mitigated, but also more importantly is as the yield on government securities go, the value of our holding on boards overcompensate the decline in investment through capital gains. Very significant 1.4 billion shillings on potential revenue purely from repricing the boards. And going to the region, we see again a clear picture appearing that the region continues to grow and increase its market share. But Kenya has bounced back in a big way to reclaim its rightful position in profitability. And we are really encouraged to see Kenya bounce back from contributing 78% of the group profit to reclaim 80% contribution. Again, and we'll see how efficient Kenya has become, and we can see the dividends that are arising from digitization of the Kenyan subsidiary. But we are really encouraged that the subsidiaries continue to outperform Kenya in terms of growth on balance sheet, giving us the confidence that as they digitize, then they will catch up with Kenya in terms of cost. And we can give you detailed data. You'll have these on each individual subsidiary, looking at return on equity, return on asset, cost-income ratio, and cost-to-asset ratio for each of the subsidiaries so that you can follow how they're growing. So we'll give you this presentation that you can then analyze where we are. I think the only subsidiary that experienced a shock last year was Tanzania. We saw what happened to Tanzania, but I'm happy to report that we are gradually working to get out of or to mitigate that shock. And we will see that the effort being put have started to bear fruits. Of course, this presentation cannot be complete without mentioning that the geographical diversification, having verified that it is productive and that it adds value to the group, we now have focused on strengthening it. And we can see the block the bank is operating on. And more importantly, one would ask, why does Equity execute this regional expansion strategy the way it has done? And all that we have been pursuing, banks facilitate trade. And the bold lines reflect the trade routes that are there, whether it's from Beira through Lusaka all the way to Lubumbashi, whether it's from Tanzania, Dodoma, Lusaka again to Lubumbashi, whether it is from Dar es Salaam all the way to Mwanza, and then eventually to Kigali in Rwanda, or it's Mombasa Nairobi, Kampala, Kisangani, Juba, and of course, we are looking at the upset to Ethiopia and Juba again. And then the Cape Town, Cairo road. That is really what has informed us to focus on a region that we can really have a grip on the trade routes and the trade patterns. And this then is strengthened even more when you look at the African Continental Free Trade Area. And then so essentially, the Atrasmala acquisition gives us the olive-shaded space. And that now, as we can see, allow us now to have a complete grip on SADC and the East African community. And then to really cover the whole Indian Ocean trade routes. So whether we are replaying what the Arabs did in the old days, we really focus on what are the trade routes and let's capture them so that we become a facilitator and enabler of trade. And we can see the impact that that transaction has. It's going to move us from a market of 265 million to 314 million. And as we can see, the GDP, nominal GDP for the region, because that is relevant to us, and the population size starts to become very relevant. And when we add up the proposed transaction, we see the balance sheet hitting 700 billion shillings, suggesting that a trillion shillings balance sheet comes to size. Because if you grow 700 billion is at December last year. If we grow it with 15%, the balance sheet is growing at, as at today, then it means that essentially you'll have touched the ceiling of 900 billion shillings. So a trillion shilling balance sheet comes to sight. And a trillion shilling balance sheet changes the dynamics of this group in terms of economies of scale. We can efficiency, and particularly with the digitization and creation of platforms. So the future looks brighter with that strategy, and that really explains. But as we close the transaction, then more data will become. And again, why these countries? We can see what is happening to Mozambique and Zambia. If you look at Zambia, the central bank rate is exactly like a East African region, below 10%, and even Mozambique is not too far off. But look at the projected growth rate. They are trading the East African ones, and at least 1.5 times higher than the African Sub-Saharan Africa growth rate. So the countries that we are picking on are countries that really demonstrate, and they are projected by 2020 both to have reached 5% growth rate. So we are very optimistic about that. Given what we have just talked about, and maybe because we have talked about a Transmara transaction, it will also be good then to talk a little bit about the Safaricom Equity Strategic Partnership. Again, when we look at that, the objective of that is really to deepen financial inclusion and to put to the disposal of the regional population the technology platform of Safaricom and the creativity and innovativeness of equity and its massive balance sheet to the disposal of, particularly of the real economy. Leaders to being a catalyst to stimulate growth at the level of the real economy, the micro and small enterprises particularly. And so these two institutions coming together, and then looking at the next slide, the funding capability that equity brings to board. We see deposits or funding of 605 billion shillings, but with only a loan book of 300 billion shillings, suggesting that we can be able to release up to 300 billion shillings using the technology capability and platform of our partner. And we can leverage on their technology, their data capability, analytic capability to really stimulate, or as Polycarp would call it, put oxygen into the real economy, oxygen of finance, cash, so that the economy really can. So Equity is very well positioned to play its rightful role, put 300 billion. In 5 years, we anticipate to have put 450 billion shillings to the economy. And Mele leading us in the region, she's prepared. Then the map we saw, Alex, if we go back to the map, this region to be able to bring the capabilities that we have in Kenya of financial inclusion using mobile capability as a bank product to the region. You could imagine putting M-Pesa in that whole region, and how much then the trade routes that we have, how efficient those trade routes would become within the whole region. So essentially that's how the balance sheet will come to play. A very agile, liquid balance sheet with 170 billion shillings of government stock that can ease, and almost 100 billion of cash. That's how the 300 billion is added up. So it is near a cash or near cash that can easily be converted into loans. What would that do? Increase the yields from 8% that we are earning on Treasury Board to 13%, and hopefully bring in an additional 42% of that increase in terms of other incomes. That is what we see. And for those who always ask, what does that mean from a financial perspective? And then we can do that efficiently. We can tap into the capability of our partner, the technological platform of our partner. Why? Because we have digitized the bank. So it is a plug and play, because our capability is in a digitized form, and there is a technology platform that can be taken. And we see what has happened to mobile, growing faster, 22%, the number of transactions that is processing. And if you compare 135 million transactions to 6 million that the branches have been able to process in a quarter, then you can see how transformed the bank is. And essentially, that 137 plus the 22 million. So we are talking about 22 plus 37, almost 160 million transactions compared to 6. You can see the ratio between fixed cost structures and variable cost structure. I don't know, Brent, if you divided 160 by 6, you get how much? You need help? 26 times. We were saying the fixed cost structure is smaller than the variable cost structure by a factor of 26. And we'll see the efficiency, what that it means in efficiency in Kenya. And hopefully we'll get this digital capability, leveraging on the technology of our platform to quickly go to our subsidiaries. And we can see it more practical. And one area that I just want to highlight here is that initially we were very strong at the personal level, that is Equitel and the apps, it's individuals. But we have seen M-Key, which we just launched in November, I think. Last year, it was not there last year, first quarter, has started to become a significant player. But I think the big thing is EasyBiz, the cash and liquidity management solution that now enables businesses to digitize. And that one may not be number of transactions, but look at the volume. The volume of money that businesses now are paying digitally. They don't have to go through the traditional transactions. And the growth of 57%. And we shall see what that has done to the branches. So we see quick growth. And for the first time, we see, because of EasyBiz, which has taken up almost 90 billion shillings from branches have stagnated in the volume of cash. The transactions have declined by 3%, but for the first time in our history, we have seen the bank not growing its cash business in the branches. And we'll see the share of branches in cash management has declined from 54 straight to 50 because of that. So digitization of the corporate businesses has started. The cash aspect have been done by EasyBiz, and hopefully by the end of this year, we shall also have digitized the application of SMEs and corporate business. I hope that is confirmed. Sure. So that will really change the way we do business. And leveraging, again, as we said earlier on, we can see the other driver of digital transactions is payments. Now, more important is how do we remove cash from the economy? And we have seen what 18,000 agents now managing 523 billion shillings in terms of, and you can see the number of transactions, millions of transactions, 523 million transactions worth 26 billion shillings. Instead of cash payment, now electronic or digital payments. And the race is to digitize retail commerce. This is digitizing retail commerce. The bank will be as digitized as the environment is digitized. And this is our big effort to push to ensure the whole country become cash light. Because the biggest cost a bank incurs is cash in transit. When cash moves and moves physically, it's very expensive to the bank. When it moves, because it has to be counted at withdraw by Mr. Y and then deposited by Mrs. X and we have to do that transaction twice of counting, and we have to really secure through insurance and cash transit charges, Wells Fargo's and the others. And now you can see we have removed 26 billion from physical to electronic money. And that has also been strengthened. Maybe if we jump one more slide and go to the next, one more slide, Alex, one more. Oh God, it's not there. We'll see it later. But Alex, I was going to EasyPay. I'm sure you know where EasyPay is, so you can pull EasyPay. If we look at this is merchant, it's POSs. We have introduced in the market the mobile payment capability. And the mobile capability has helped us now to make it easy. Alex is page 29. And we can see what has happened. The number of transactions have moved in February from 166 to 203. And for the first time in a month, we have EasyPay processing a 1.1 billion shillings. And that, as we can see from the volume, the percentage growth of volume of transaction 157% against the growth of number of transaction 94, suggesting EasyPay, because it's a high volume capability, because it's a bank transaction, you can do 1 million shillings. We are now able to move trading at the retail level through EasyPay. And maybe this is the greatest capability with our partner Safaricom would bring if we converge EasyPay and Lipa na M-Pesa. such that we make them completely interoperable and bring all the capabilities, whether it's credit cards, debit cards, or mobile, all to one mobile POS, or converge that. So this is the big thing about making the economy efficient, removing cash from the economy. And if there is one area this partnership will do, is to help Kenyans to ease the burden and risk of carrying cash and make the economy very, very efficient. It doesn't need to print cash. It just needs, because cash will be moving digitally. The velocity of an electronic or a digital transaction to a manual transaction are very, very different. One carrying cash from Equity Center to Gikomba to buy goods, and another one studying at Gikomba and completing the transactions. Once they pay, they receive the goods, and the cash is in both, is moved from one bank account to another, or from one outlet to another. That is the real focus of making the economy efficiency. That's where the partnership would really bring huge. So that will then combine with this traditional credit card business, merchant banking, to make payments throughout the country as cashless as possible. And so, as we said, we are focused on promoting this. It's not about fees now. We'll make our money from foreign exchange, but we can almost make this transaction free, just to ensure we reduce the cost of cash handling in the bank. Total revenue is a function of income minus expense. So if you remove expense, you create a higher income, total income, than focusing purely on income. So strategically, like we did with mobile, and everybody kept on asking us, what will be the revenue for mobile? We have seen mobile removed the cost structure of the bank. So again, the strategy here will be focused on that. And moving on, we see the impact it has. Branches are only left doing now 3%. And we can see the move year on year. Last year, branches were doing 4%. Now they are doing only 3%. People always tend to misunderstand this slide and say banks are retrenching. It is jobs that are being redefined. We have 46,000 agents which have each to employ a person to be able to do these transactions. We have 18,000 merchants that has to employ somebody to process the payment. So jobs are being redefined, skills are being redefined, and that is the efficiency we can bring into the economy by collaborating with Safaricom and redefining jobs, move people from manual jobs to digital jobs. But it's more of a redefinition. The jobs increase exponentially, maybe from 2,000 bank jobs to 60,000 retail jobs. So again, that is what we can see. And as we can see, the mobile continues to increase. When you look at, let's look at what we talked about, EZBs. We have seen the cash that used to be handled by the branches, 54%, quickly has been reduced to 50%. Why? Because the businesses are becoming digitized, and the businesses are doing their transaction real-time, online, on EasyBase, a cash liquidity management program. And our team leader was last year Batuan's youngest banker, the banker of the year. Kaki, where are you? We are grateful for what you are doing on this transformation of businesses. And moving on, we see loans again. We can see last year mobile lending was at the branch level was 93%. That has been reduced to 80%. As we say, as we now digitize the micro, the small and medium businesses, we'll see maybe before the end of the year, 50% of the lending now be happening on the mobile. And this will essentially look like cash, maybe in a few. Again, to accelerate our digitization, we have converted FinServe, rebranded FinServe, from what was traditionally known as Equitel, an infrastructure company, to FinServe, a fintech. And the fintech, as we have seen, has really focused on online payments, and we have seen how it has helped the bank, and we have seen the APIs, the adoption of APIs, and the M-Key, the first fintech product that allows, and we can see within the first 3 months, we have 320,000 downloads. And if we go to the next slide, we see the level of downloads and activation, growth on a month-to-month basis. And when you look at the activity level of those downloads, we see whether it is the transaction in millions increasing significantly, and loans by a fintech. This is not competing with Equity Bank. The fintech is now competing with the other fintechs, the Tala, the brands, and also competing with the telecoms that are in the financial space. So we now have two arms: bank, a digitized big bank, and a fintech, a startup of a fintech on the shoulders of a giant, and quickly we can see it building the size. And as we said, we combine the payment rails. The payment rails of the bank is also what the fintech uses. So the APIs that we expose that allows people to process their payments then are connected also to the retail commerce rails. And that is really more shared, and that is why it is growing much faster than we saw. And looking at that, maybe the big thing that we can see is what we talked about, digitization. And Kenya, where it has been successful, we see the staff costs starting to decline. And that's why we talked, I think somebody said, yeah, Equity, number of staff has declined by 400. So even if you put salary increments still, it's so natural attrition. Most of these people are saying, can you give me an agent to go and run my own business? Yes, 46,000 agents out there, very profitable. The best agents make about $1 million shillings per month. So essentially, it's a very attractive venture to retire to if you are an employee of Equity Bank. And we can see the impact on the cost-to-income ratio. No, Alex, still on the same slide. From 48 when last year to last year but one to 42 to 41. This income cost ratio has been achieved when lending rates has declined from 14 to 13. That is, if you really put that into account, then you see how big that reduction is, because the yields have declined by over 100 basis points. And we can see Kenya is pulling the group, and staff costs have stagnated for the group, and we can see the cost-income ratio, despite the growth of the subsidiaries. We saw their balance sheet growing to control 26% of all the assets. That growth is not translating to higher cost-income ratios. The investment costs are being reduced, and we are optimistic. And if we can achieve this with 600 billion balance sheet, yes, you can then see the economies of scale being applied on a trillion shillings balance sheet, as we anticipate we will be able to achieve by next year. The cost structure, the IT platform will remain the same. If you look at other costs, you see other costs a little bit of strain, and you can see it's in Kenya. It's simply because we continue to strengthen our IT platform, particularly from a security perspective. That's the investment, just to revamp the security, and strengthen the platform, put most of the non-critical functions to the cloud, so that we are ready to take the whole 1 trillion balance sheet. So this is a pre-investment. Other costs, somebody asked me, why are other costs growing by 10% faster than all the other costs? It's IT security and IT readiness, platform readiness that we are. But as we do the acquisitions, that cost will start coming down. Before the banks we have acquired, you would need, if you integrate, to shut their systems and just put them on this system without any additional investment, and then reduce the cost that those 4 banks were incurring. And of course, as we said, when you look at the yields have come down from 11% to about 10%. And as equity, we say the power of digitization. Look at what has happened to the cost of funds. Because it's variable infrastructure, it's agent, it's mobile, that is mobilizing the funds. The cost of funds have declined from 0.7 to 2.6. And that is the competitiveness of Equity Bank. That because of its sheer size, 13.7 million customers on a digital platform, then you could be able to mobilize significant. With the ease of digital wallets, with the ease of a bank in on your phone, from converting a bank from where you go to what you do on your devices, then the cost of mobilizing those deposits continue to decline. And that has helped us to cope with the declining interest rate significant. That's why we said we have now evolved a way of lending, and we'll see lending growth in spite of the interest margin coming down from 8.5 to 8.2. And we can see the yields, what really has caused the yield on earning assets to come down. On the next slide, Alex, is the declining yield on government securities and the 100 basis decline on the interest lending rates. So we are being compressed from both sides, treasury and lending. But because the cost structure is very versatile, then we are able to maintain our cost-to-income ratio despite the decline in yields. So cost of funds, as we can see, have moved from 2.6 to 2.7, and the cost of deposits. It's not that we've penalized deposits, it's the other costs. So the cost of deposits remain at 2.7, and the yields on loans, as we have seen, moved down from 12.7 to 12.1 because of reducing lending rates from 13% from 14% to 13%. People always say there are banks that are more expensive than others. There's nothing like that, because this is regulated lending, and you have to transmit. That again shows what we do. Anybody who has a loan in equity, if the interest rates go down, they go for everybody, not the new lending, for existing loans. And we can see what happened with the 100 basis point reduction of cost of funds. And that then brings us close, Alex, to the end of the slides, but you can't close without talking what has happened to the asset quality. And we can see our NPLs at 9% when the industry is almost at 13%. So we have maintained the quality of our loan book, and we can see the coverage, particularly in Kenya. We have managed to maintain it at 78%. And we can see the increase from 7.6 to 9% where it has come from. It has come from Tanzania. We have shown you the country contribution but we are confident we'll be able to manage Tanzania. And we also know where the problem has come from in Kenya. It's large enterprises and SMEs that are feeling the pain, but that is secured loans. Because they are secured loans, that is why you don't, the coverage is not 100% because you take into account the securities you are holding. So if you take the securities we are holding, they are more than 100% covered in terms of coverage. So we are also very happy about our capability of building a high-quality loan book. And then goes to what others lead the economy. And this slide then shows what our partnership with Safaricom would do. The first one is in currencies. As we can see, 75% of our loans are in Kenya shillings. So again, that allows us to use that platform very efficiently for 75% of our loan book. The second thing is the distribution by sectors. And we see the real sectors, whether we talk about trade, transport, that's where the bank overlaps, and that is where the technology platform of our partner Safaricom overlaps. And that is why we are saying we are bringing the convergence of technology and money together to the real economy, to the real sectors that contribute to the economy. In a traditional bank, you would be seeing the corporate to be the big thing, but as you can see, building and construction. Again, that is very good. We have disclosed that so that people see the strain in real estate has not affected the bank because we are too. Where do we expect to grow significantly? The value chains of manufacturing, and it will reflect itself in trade. It's where you see the largest growth will be on trade. And then the personal households. Those are business, personal business registered names and personal enterprises. It's not consumer lending as such. And we can see the country contribution. The why that partnership can work very significantly is because 75% of the book is in Kenya. And we can see SMEs control 60% of the book. And that is where the oxygen is most required. It's in the micro businesses, it's in agriculture. So we overlap completely with the economy. Why? Because of our 280 rural branches, and then so the coverage of the country. We have the best coverage in terms of our presence in the country. And so the two infrastructures overlap. And really, if whatever catalytic effect they have, it means the rain will rain and oxygen will be felt in every part of the country and in every sector. And that is why we are very confident that that partnership is about Kenyans, is to benefit Kenyans, to enable Kenyans to do what they need to do to improve their lives and livelihoods, and to participate in the economic transformation, and to take the advantage and benefit from the economic transformation. And lastly, we have retained our rating. Alex reminds me that we stand for shared prosperity, and we're very excited to see the readiness. When we talk about pushing oxygen, you can see 1.8 million youth, women and youth, has been trained in readiness to receive credit to stimulate the real economies in which they are acting. We have seen that 1,000 small and medium-sized farmers being supported to be ready for this partnership. And we have seen even the peasant farmers being turned into agro-businesses. But the biggest one is the micro, small, and medium enterprises, where 44,000 have been trained. And those ones can easily, as we can see, they can access 6 billion shillings, 6.5 billion shillings. So that capability will converge the capability of the corporates and their foundations, particularly in building capacity. And we hope, hopefully, this will see a significant transformation of the Kenyan economy to ensure the bottom of the economy, the real sector, receives the benefit of the rapid growth that the economy has been experiencing from infrastructure investment. And the bank continues to enjoy very high ratings, still sovereign rating by Moody, sovereign rating by GCL, and we continue to hold our top positions on the top 1,000 banks. And we feel very, very proud. And we can guess, once we complete this transaction that we have been talking about, our ranking, Alex, if you go back one slide, hopefully will be now in the top 500 banks on earth. And with size of 500, and if you retain your global position on return on assets and soundness, then this will be a bank that will be converting Kenya into a global or regional financial center, that capability. And pulling nearly 10 countries together and centering them and their capability, a regional balance sheet of 1 trillion shillings. If you look at 1 trillion shillings, it means most likely capital would be close to 200 billion shillings. And 25% of 200 billion shillings, it means we move to a single lending limit of 50 billion shillings. So we can now start financing infrastructure, and we don't have to always go to China when we want to extend our railway line from Naivasha to Kisumu. We can do it locally because the balance sheets are significant. And that is why we think this will be very important to the economy. And the blood continues to be as strong as it could. It can be better. We know it is going to be refurbished. The banker continues to rank as best. Think bank business continues to rank as very strong in every respect. And essentially, the market has also rewarded us very well. And we are proud. We are 22 billion shillings bigger in market capitalization than the next largest bank. After the transaction, we'll be at least 50 billion shillings bigger than the next largest bank in the market. So again, we start seeing for shareholders what this bank means. For liquidity in the Nairobi Stock Exchange, the impact that this bank would start having, and the level of liquidity that this bank can bring to bear. Now, this story can't end without talking about the numbers. So let's talk about numbers. Stories are good, numbers are sanity. And we see the balance sheet of the bank go to 15% growth rate. And we're saying, looking at where the economy is, looking at where the sector is, the financial industry is, a 15% growth rate start to suggest the organic growth has fast-tracked, and equity market share is significantly increasing. The economy is not growing that fast. The sector is not growing that fast. It means it is market share that is increasing. And when you look at what is driving that market share, is customer deposits growing at 12%. As a customer, faster than last year by about 12%. And so that's more of market share growth. And we see the allocation now is disproportionately in favor of loans, suggesting the yields will start playing back. And we'll see that playing in the P&L quite soon. And we see the strength in shareholders' funds supporting the same growth. The growth of the balance sheet is 15%, but shareholders have growing at 16%, suggesting it's completely anchored. Capital ratios and regulatory ratios must all be met because of that, and given the quality of the balance sheet is pretty strong. Turning to the P&L, we see again now the momentum, their own growth converting into growth in interest income, 7%. We look at a growth rate of 12% of deposit, translating to 7% growth in deposits, cost of deposits. And you can see the pairing. Loans grow, deposits grow by 12%, and that translates to 7. Loans grow by 13%, translates to, so the efficiency of the bank is maintained, and the yields of the bank are maintained. There is no impairment. There is no inefficiencies in the system, and there is no leakages in income, and there is no wastage in expenses. It's a direct translation in terms of ratio. And we see, again, we didn't need to increase significant provisions because the quality of the loan remain good, but we are conservative. The 1.4% growth in NPLs, we increased our provisions by 14%. Staff costs, as we say, remain stable, and other expenses, as we said, is purely security, cyber security, investment, and platform readiness to integrate the new 4 subsidiaries that will be coming on board. That's all that the cost we will incur, and we have incurred it in the in advance. So we can see that the marginal contribution in cost will be almost zero or increase in zero, but the revenue will significantly be an upside. And we'll see this cost when they hold. And that leads us again, cost 7%, profit before tax 6%, increasing from 8.3 billion to 8.8 billion, confirming the sustainability of this bank and our contribution to public in terms of first quarter, giving the exchequer 2.6 billion shillings. Looking at returns on equity and return on asset, Kenya, again, improving its position. We always talk about Kenya because of its size. That's why we show it separately. And that momentum, Polycarp, you have proved you are better than me. Congratulations. And the group, maybe we could do with 27. Try and sort out Tanzania faster. I think that small dent is Tanzania, so everybody can understand where the challenge is, and continues to give a return on asset of 4.2, which then ranks us still among the most, the best banks on earth in terms of return on asset. And as we said, the ratios, these are the most important thing. We look at the yield on loans, declining because interest rates have come from 14 to 13. Yield on government securities declining by 0.7, and yield on earning assets again declining by almost 0.3. But look at the cost of deposits. It improves at the group from 2.5 to 2.4, and cost of funds from 2.7 to 2.6, giving the most needed impactors in growing their own book. And cost-income ratio, we see better days coming as we grow the balance sheet, because that, as we see, it is stable. Despite all the interest capping shocks in the market, we've been able to reach stability. And loan-to-deposit ratio, again, suggesting the headroom that we can go. And as we can see, the capital ratios are so strong that we can integrate the 4 subsidiaries, the 4 new subsidiaries without impairing our group capital ratios. And liquidity, as we said, it's at 57, showing maybe the ability of the bank to unleash its capability through the partnership with the Safaricom, and maybe breathing new life to the 4 subsidiaries that might have been constrained by liquidity, the ones that we're buying. Outlook, looking at what we had promised, the growth on loans, we had promised 10 to 15. We're right in the middle of it at 13%. Deposits 10 to 15, we are 12. So it means that we have validated the output and the P&L. Then we look and we see this time we seem to be almost there. Interest margin, because of that we are working very hard as we shift more treasury instruments or government stock into lending. We believe that interest margin will even be much better than we had expected. And we are almost where we needed to be on the mix of income. And we've said that's like cost-income ratio where we expected. And once we get the margin right, we are confident. We are ahead of return on equity. We had expected 25, we are already at 26. And return on assets, we expected 3.8 to 4.5, we are at 4.2, meaning with the adjustment, we should be at the top end of 4.5. And cost of risk on NPLs, we are confident we'll work on there. And the subsidiaries now, we'll be talking a different story. Once we integrate the 4 subsidiaries, Kenya will now certainly be challenged to about 60%, and the subsidiaries straight away to 40%. What have we done instantly? De-risked the sovereign risk, Kenya. Completely de-risk, and hopefully 1 year down the road, by next year, Polycarp, you'll be lucky to contribute 50% to the group. And then the sovereign risk, we become a regional, a complete Pan-African or regional bank without overweight on a sovereign risk of a single country. And almost the journey will then have been completed of what we wanted to do with the 15-country diversification, where we ensure no country contributes more than 30% of our risk, so that we disconnect sovereign risk and business risk. At the moment, they are tied. The Kenya sovereign risk and the equity risk are almost tied because of the 8% balance sheet. But that will quickly, within 2 years, be able to disconnect, so that the investors can take comfort that their risk basket is diversified enough to mitigate them from any effect of a sovereign risk. I think, Alex, we can stop there, unless you want to introduce another slide, and then hopefully, if there are a few questions, we can take them. Thank you. Thank you very much. Polycarp, you seem to have been spared. I thought you'd receive 1 or 2 questions, but you seem to be spared. Mary, you also seem to be spared the questions. Brent, the investors don't have questions. So do you need an investor's call in the evening? Oh, there. First question.
Good morning. My name is Omar Mohammed, and from Reuters. I have a question about the NPLs.